Do you understand the risk you take when you invest? What is risk? Here is the dictionary definition: a situation involving exposure to danger. That makes sense, but that seems more applicable if I jumped into a lion exhibit at the zoo. But what does risk mean when you are investing? Could you temporarily or permanently lose some of your money? What about all your money? Might you go an extended period of time with lower than expected returns? Will you underperform in bull markets and outperform in bear markets? Perhaps vice versa. What is the likelihood of your strategy working over 1 year? What about over 5 years? 20 years? What does it look like if it doesn't work? How bad might you underperform? What return should you expect? What if expectations are not met? What does that mean? Do you know the answers to all these questions? If you have no idea, you have no idea the risk you take. If you don't understand the risk you take, very likely you will make poor decisions when the risk you take rears its ugly head. So let's make sure that doesn't happen. Let's first talk about traditional risk. What is that? These are backward-looking metrics that set future expectations. Let me give you a few examples. Volatility. What has been the spread of outcomes or returns previously of a particular investment? If the spread is large, the expected volatility is greater. If the spread is small, the expected volatility is less. Notice the spread of a portfolio 100% invested in stocks in red here. Best year on the high side and worst yearly return on the low side, with everything else falling in between from 1926 to 2019. Now compare that to an all bond portfolio reflected in the darkest blue bar on the opposite end of the spectrum, which has higher volatility, an all stock portfolio or an all bond portfolio. If you don't understand after that explanation, I can't help you any further. Max drawdown. How far did a particular investment fall from peak to trough? How much should you anticipate or be prepared to stomach during a bear market or if your investment asset turns south for a period of time? Here is the growth of U.S. real estate from January 1st, 2000 to the end of 2023. It's not a straight diagonal line up, unfortunately. There's risk if you want return in real estate. What has been the max drawdown over this 24-year period of time? From February 8th, 2007, which was the peak, to March 2nd, 2009, the trough. U.S. real estate dropped 72.75%. Can you handle losing 72.75% of your investment value? It's a question you should be asking yourself. Correlation. How correlated is your investment to the general market? This one can be a bit confusing for unintelligent people like me. You own an S&P 500 index fund. That would be highly correlated to the S&P 500 index. Think of it this way: the price of those two, the index and the fund, will move like two well-practiced, synchronized swimmers. What if you own a single stock within the S&P 500 index? I would classify that as partial correlation to the S&P 500 index. Perhaps the price of each moving like two very novice synchronized swimmers, sometimes getting out of sync, moving in opposite directions here or there, but generally moving in the same direction. What if you own a single small cap stock? Let's say that's lower correlation to the S&P 500 index, which is made up of large cap stocks. The price of each moving perhaps like two toddlers swimming around in a pool, chasing each other, running away from each other in opposite directions. I hope you get the gist. Lastly, let's say you own a baby grand piano. Now we're going to say that has little to no correlation to the S&P 500 index. Perhaps maybe two fish swimming in two different oceans. Every now and then they could be moving in the same direction in the two different oceans that they exist in. Who knows, it's a weird world. Let's try a different example, perhaps without stocks, to make sure you understand this one. Let's use cars. You own a 2020 Ford Explorer. That would have high correlation to the 2020 Ford Explorer used car market. What if you own a 2010 Ford Explorer? That would have partial correlation to the 2020 Ford Explorer used car market. What if instead of an Explorer you owned a Tesla? I would say that has much lower correlation to the 2020 Ford Explorer used car market. There might be some in the used car market generally, but an electric, nice, fancy car is probably going to have lower correlation to the 2020 used car market. Lastly, what if you own a collection of cat sweaters? I'd say no correlation, and you probably shouldn't tell anybody. Understanding traditional risk, like these examples here, are important because setting proper expectations is vital when you invest. Now, let's talk about another kind of risk, active risk. What is that? The current investment decisions you are making right now. Here are a few brief examples. Waiting for the market to drop before investing. I'd call that opportunity cost risk. There is a lot of opportunity or growth that often occurs when people are waiting on the sidelines, just statistically speaking. What about investing all your money at the top of the market? Let's call that bad timing risk. What about chasing investment returns? This is common, by the way. Let me explain. Look at this beautiful, colorful thing here. Each box represents a different segment of publicly traded markets. Large cap stocks, small cap stocks, real estate, international stocks, bonds, etc. Do you see any pattern? Does high performance one year guarantee high performance the next year? It does not. Well, what about different sectors in the US stock market, like energy, financials, healthcare, or industrials? Any pattern you see? And what about different countries? Is there a pattern to be found? I think not. Light blue is the United States, by the way. Chasing returns means looking at what did the best that year or the previous few years and moving towards it. Always moving, always chasing. Let's call this not understanding investing risk. That sounds harsh. I feel bad. How about not understanding risk? Maybe being impatient, risk. Being greedy, risk. Maybe being nervous, risk. If you couldn't tell, I'm making up names for the different types of risk here. Actions have consequences. That is really all I'm trying to get across when talking about active risk. With investing, sometimes people don't understand the consequences and risk they take with the current decisions they are making. Guess what helps mitigate active risk, aka poor and emotional decision making? Understanding traditional risk. See how I tied that together? So let's start rolling with the punches a little bit. Mike Tyson once said, everyone has a plan until they're punched in the mouth. I am sure every boxer went into a fight with Mike Tyson with a game plan, and then he punched them. What do you think they turned to after that if they didn't get knocked out? Likely their most primal defensive and offensive instincts, the fight or flight instinct in all of us. What do you think your primal instincts will be when your investments inevitably punch you, kapow, right in the mouth? The best training is knowing the risk you take and being okay, or telling yourself it will be okay, or making sure you will actually be okay if it actually happens. So let's go through 2 training exercises to prepare you. Let's say you want to invest solely in the S&P 500 index or large US stocks because of how well they have performed over the last decade. Here, we're looking at the 2010 to 2020 decade. The S&P 500 index, the green line, did really well, outperforming smaller cap stocks, the blue line, international stocks, the orange line, and bonds, the purple line. Most people's primal instincts upon casting their eyes on that seductive data is buy an S&P 500 index fund and nothing else. Hey, I get it. It's enticing. But look at the 2000 to 2010 decade. The S&P 500 index returned a negative return over this time period, with small cap stocks, international stocks, and bonds all outperforming. What a conundrum we find ourselves in. What do we do? I don't really even know. But I do know if you concentrate too heavily in one asset class, you will likely experience more risk, more volatility risk, more max drawdown risk, to name just a few. Quick plug, go check out my video on international stock exposure and if you should still be investing there in light of the data I just showed you. I cover many more interesting details like the training exercise here. Link in the description below. Let's do one last training exercise, holding money in cash versus holding money in stocks. In 2022, parking your money in cash would have provided a 1.94% return. Small, but what do you expect? It's cash. Let's compare that to stocks, doing a negative 18.36%. And what if I told you that in 2023, cash would generate you 5.02%? Would you stay invested in stocks that just performed dismally over the guarantee of 5% in cash? I don't know what you would do. I don't know. It's tempting, but really not tempting if you understand that an 18% decline is part of the risk you take when you invest in stocks. In 2023, stocks did 22.2%. What about stocks versus cash starting at the beginning of this century? January 1st, 2000. Do you know after 3 years, stocks would have been a negative 38.5% versus cash that would have been 11.13%? That's hard to stomach. What about after 6 years? It gets worse. Stocks would have provided a 5.16% return versus cash that would have have done 17.3%. Then after 10 years, 10.53% for stocks versus 30.07% for cash. So why would anyone want to invest in stocks? I don't know. Perhaps someone who understands volatility, max drawdown, or just bad timing risk. The decade from 2000 to 2010 was rough, beginning and ending with major stock market recessions. I might have cherry-picked a little bit there, but this could be the next decade. That is some of the risk you take when investing in the stock market. But this story doesn't end sad. What if you held on until now being December 31st, 2023? After 24 years, 252.78% for the stock market versus 47.67% for cash. So after a dismal decade from the beginning of 2010 to the end of 2023, stocks did 219.18% versus cash, which did 13.53%. That, my friends, is why you hold on to stocks. That is also why a financial plan is really important to know how much should be allocated to cash, to bonds, to stocks, and to other alternatives to help manage the risk of investing based on your current circumstances. And now you're trained. Go forth, be brave, and revisit this video every couple of months. If you'd like more training or a new friend that will help you with your financial planning and investment management needs, check out the link in the description below to learn more about me. Until next time. If you don't understand, if you don't understand, I'm having a hard time here, but I can do it. I'm capable. To the end of 2023. Can you handle losing 72.75%? I'd call that opportunity cost of risk.